The highest-yielding dividend ETFs are actually destroying wealth for most investors, and I'm going to show you exactly why. I'm Marcus Hale. 15 years ago, I was sitting in a Manhattan office reviewing equity portfolios all day. Back then, I thought yield was everything. The higher the dividend, the better the investment. That was the logic. I've since learned that's one of the most expensive mistakes you can make in investing. Last year, I helped a client review a portfolio that was generating nearly 8% in annual dividends. Sounds great on paper, right? The portfolio held JEPI Killed, some leveraged covered call ETFs, and a handful of high-yield bond funds. When we dug into the numbers, something alarming emerged. Over the previous 5 years, even with all those dividend checks hitting the account, the portfolio had barely grown. The distributions were literally cannibalizing the principal. That's what I want to talk about today. Not whether you should own dividend ETFs, you should. But why chasing the highest yield is a trap that costs you thousands, sometimes hundreds of thousands of dollars in lifetime wealth. Let me start with what I'm seeing in the high-yield ETF space right now. When I review client portfolios these days, I see a lot of JEPI, Killed, and similar funds. These ETFs are designed to generate income through covered call strategies. Basically, they sell call options against their holdings to generate extra cash. On the surface, this sounds brilliant. You get a 7-8% yield plus the underlying stock appreciation. Here's the problem I've watched unfold hundreds of times. Those covered calls cap your upside. When the market rallies hard, your shares get called away at a predetermined price. You miss the big moves. Research from Morningstar shows that covered call ETFs typically underperform their underlying benchmarks by 150-200 basis points during strong bull markets. That's 5-2% annually that you're leaving on the table. Now compare that to Schwab U.S. Dividend Equity ETF. Yields around 3-5% and has an expense ratio of just 0.06%. That's almost nothing. When I analyzed performance over the last 10 years, the total return, dividends plus capital appreciation, crushed those high-yield alternatives, even though the yield looks smaller. Let me give you the math that actually matters. Suppose you invest $500 a month into Stata 5% dividend yield with 7% total annual returns. Over 30 years, that compounds to approximately $386,000. Now, let's say you chase high-yield ETFs yielding 8% annually. But due to covered call restrictions, your total return is capped at 4-5% because you're missing upside during bull markets. Same $500 monthly contribution. Same 30-year timeline. You end up with roughly $287,000. That's almost $100,000 in foregone wealth, and that's being generous with the 4-5% return assumption. The yield trap is seductive because you see those dividend checks every quarter. Psychologically, that feels like winning. You're getting paid to hold the stock. But if the underlying asset isn't appreciating, you're just slowly liquidating your capital and calling it income. There's another risk I've seen tank portfolios: sector concentration. When I reviewed sector weightings in popular high-yield ETFs recently, I noticed something troubling. Many of these funds are heavily concentrated in financials, utilities, and real estate. Killed, for example, has significant weight in covered call writing, which means it's essentially betting on range-bound markets. But here's the risk. If the market enters a sustained uptrend, which has been the historical norm, these strategies underperform badly. Compare that to VOO, the Vanguard S&P 500 ETF. VOO holds the broad market, with technology comprising roughly 28% of the index as of recent data. It yields only about 1.6%, but you're getting diversified exposure to the entire economy. Your capital grows with GDP. You're not artificially capping returns through covered calls. I had a client, Jennifer, who came to me in 2022. Her portfolio was 60% high-yield dividend ETFs and alternative income strategies. She was pulling in about 7% annually in distributions. But when we stress-tested the portfolio, asking what happens if we enter a 10-year bull market, the math was grim. She was essentially trading long-term wealth creation for short-term cash flow. We restructured her portfolio to 70%, 20% VOO, and 10% individual dividend stocks she understood. Her yield dropped to about 2.8%. She thought I was crazy. But 3 years later, after the 2023-2024 rally, that portfolio had appreciated 45%, and she was receiving higher absolute dollar amounts in dividends because the underlying assets had grown. This gets at something fundamental about passive income that most people get wrong. You don't build wealth by maximizing current yield. You build wealth by maximizing total return, dividends plus capital appreciation, and reinvesting both. Let me address the expense ratio issue because this matters more than people realize. It has an expense ratio of 0.06%. VIM Vanguard High Dividend Yield ETF comes in at 0.08%. Both are incredibly cheap. Now, many actively managed high-yield funds charge 0.40-0, 60% annually. On a $100,000 portfolio, that's $400-600 per year in fees. Over 30 years with compounding, that's the difference between ending with $763,000 versus $864,000. That single percentage point of drag costs you $100,000. When I've analyzed the historical data, high-yield ETFs charging higher fees rarely outperform low-cost alternatives enough to justify the expense. The math simply doesn't work. The dividend yield differential between a 3.5% fund and an 8% fund would need to persist for 2 decades with zero capital appreciation in the high-yield fund for the fees to pencil out. There's also the tax efficiency problem I've worked around countless times. High-yield ETFs, especially those using covered call strategies, tend to generate higher short-term capital gains. Those are taxed as ordinary income, up to 37% at the federal level if you're a high earner plus state taxes. By contrast, distributes mostly qualified dividends, taxed at preferential rates of 15-20%. If you're in a high tax bracket, that 3.5% yield is effectively higher after taxes than an 8% yield in a high turnover covered call fund. I worked with an accountant on this about 4 years ago. We looked at the after-tax returns of 3 comparable portfolios. The high-yield, high-turnover portfolio wasn't just underperforming on a pre-tax basis. After accounting for taxes, it was underperforming by an additional 1.5% annually. That compounds. Here's what I tell clients about building real passive income wealth. First, accept that sustainable dividend yields are in the 3-4% range for quality dividend growers. At 3.5% is actually excellent because those dividends come with a track record of growth. Dividend increases historically average 8-12% annually for quality payers. So in year 1, you get 3.5%. In year 5, that yield is potentially 4.5% on your original investment. That's how you build increasing cash flow, not by chasing static 8% yields that never grow. Second, prioritize total return.